A lot of people are worried about their banks nowadays with the recent failure of Silicon Valley Bank, SVB, and Signature Bank. We've been fielding a lot of questions about, okay, what is FDIC insurance? How does this pertain to me? How do I make sure that my deposits are protected? So that's what we're here to talk about. My name is Michael MacKelvie. I'm a certified financial planner with Mariner Wealth Advisors. I'm joined by Valerie Escobar, who's also a certified financial planner with Mariner Wealth Advisors. This is Your Life Simplified. Make sure to subscribe if you haven't. Valerie, I know I've been fielding a lot of questions from clients around this subject, understandable questions, because obviously we deal in the financial sector. Can you maybe just start by explaining what FDIC insurance is?
Absolutely. Yes. So one of these things that we don't think about until we all of a sudden need to, as usually is the case with insurance. So FDIC stands for Federal Deposit Insurance Corporation. This is a protection insurance that is created and provided so that investors or savers, people that go to a bank, have a certain amount of their money that is insured. And so if the bank ever becomes insolvent, then their money is still protected. And it's not unlimited. There are a couple of parameters around it, and I think we're going to dive into that.
Yeah, we'll touch on that. And I think some key notes, because this acronym FDIC insurance, it's funny, our producer right before this mentioned, it sounds like just a made up term. This is very much a real entity though. So it was actually formed after the Great Depression occurred. The idea of it was creating a bank-funded insurance pool to protect for these exact situations. So the question sometimes comes up, is this going to come from taxpayer money? And for big bailouts, that maybe could have been the case. You could argue that's been the case in the past. For these smaller instances where the FDIC is literally taking over, unlike maybe Citigroup, for example, which was a much bigger case, it is a takeover by the FDIC insurance, in this case, which is funded by bank premiums. Those bank premiums, I can assure you, are going up given what's occurring. But basically, one key note on this, there has never been a single penny lost since this corporation was created in the 1930s. So if you had an FDIC insured account since this corporation, this FDIC insurance was created, there has never been a single penny that was not covered by the FDIC when a bank failed. Okay. And I think we're being reminded now that yes, banks can fail. But the question, of course, that sometimes comes up, okay, how many banks can fail? How many of these small banks can fail? I want to address that real quick. They have this pool that is funded by premiums, but in addition to that, the FDIC is backed by the full faith of the U.S. government. So even in the event that that pool went dry, which would be substantial, far more substantial than anything we're seeing right now, they would be backed by the full faith of the U.S. government. So I think that's actually a good thing, just to reference, hey, this isn't coming out of taxpayer money to bail out Silicon Valley Bank, Signature Bank. This is FDIC insurance premiums that are paying for this. Now, of course, the question I think that follows is we talk about who's protected and how much am I actually protected for. Valerie, how much are you protected for? And how does this work at the account level? Because I think people hear a number, but they're a little unsure when it actually comes down to specifics. What accounts are covered?
Yep. And so like all good financial questions, the answer is it depends.
Yep.
$250,000 is that magic number that everybody thinks on. And that applies to individuals. And so you can look at it in different ways. So if you, Mike, let's say for some reason you came across actually having a whole bunch of money. And so you had $250,000.
We need a few more viewers. Yeah.
We're working on it.
Yeah.
So we put one account, you open up one account in your own name. $250,000. So that's insured. You open up a second account where it's a joint account. So it's you and your newest friend, Molly, for some reason, open up account together. You each put $250,000 in. So $500,000. That's a second $250,000 because the titling is different of your own money. Now we can go a little bit further, and this can get as complicated as you could want. There's FDIC insurance, or FDIC's website is actually fantastic in helping people figure
They have a
this out.
calculator to run through the different
Exactly.
instances. Yeah.
Yep. Yep. And I think really that last piece that I would put, retirement accounts. And so if you have 250,000 that you put in retirement accounts, they actually pull all those together. So if you have a Roth and an IRA, a traditional IRA, the total between the two is 250,000.
Mm-hmm.
And let's touch on trusts.
Yeah.
This will be the last one that I look up. This one's interesting because it's based on the beneficiaries. So if you and Molly each have a trust account and you have 10 kids together, if the limits would not cover all 10 necessarily, it's kind of nuanced, but really it's based on the number of beneficiaries per owner. And so 250 per beneficiary up to 5 for you, and then another 250 per beneficiary for Molly. Again, the calculator is a really good way to look at it, but there's quite a bit of professional
scenarios. Yeah. Mm-hmm. Yeah. Yeah. And I want to make a couple important distinguishing points that was well laid out. This is for FDIC insured banks, right? So
yes,
obviously you want to make sure that a bank has FDIC insurance, or if you're with a credit union, which is a very common question as well. Hey, how do credit unions operate? Are they covered by FDIC insurance? It's a little bit different. It's actually not FDIC. It's a different corporation, very similar numbers and methods that covers that. So there's insurance premiums that create a pool, in this case, for credit unions. It's just a different organization that does that.
Another alphabet soup.
Yeah, you'd want to make sure, I believe it's NUCA is the acronym for it, or NCUA, National Credit Union Insurance Association. But anyways, so you would want to make sure that your account is insured at the FDIC insurance level or through, let's just say, this credit union. Now, per account, let's again go back to a quick example. Let's say you're married. I have $250,000 in my account. I could have my own account with a bank. My wife could have $250,000 in her own account at that same bank. And then together we could have a joint account for $250,000. So you can see how that can add up. Now that's per bank. So theoretically, you could go to another bank and get the same protections additionally. So if I was single, I could have $250 at my account at one bank, go to another bank that has FDIC, open up another $250. That might get a little complex from a banking standpoint. There's actually some solutions that we help people out with in regards to that to make it a little bit easier for them, but it's per bank. So that's one important distinguishing point there that I just wanted to touch on. Now, another quick point, this does not cover the investment loss potential of, let's say, stocks, bonds, annuities, life insurance. So yes, you could have maybe a brokerage account, which we'll get into here with SIPC, that has some stocks and bonds in it. FDIC would not cover that in the event that account came down. Okay, so it's different. We're talking about CDs, savings accounts, joint accounts, some money market bank accounts, keyword money market bank accounts, not just money market funds that would be FDIC insured in this case. Okay. So now, Valerie, as we transition maybe here and we look into SIPC, maybe help us understand the difference between FDIC, SIPC, because again, we got acronyms, alphabet soup.
Yep. So SIPC is for brokerage firms. And so when you're investing your money, there is a likelihood that you're going to lose value. The insurance, SIPC, which Securities Investor Protection Corporation, this does not protect against the loss of investment, but it does protect against the failure of your brokerage firm. The coverages are a little bit different. So it'll be $500,000 per account, per, how do they put it, as separate capacity is the way that they title it. So it's a little bit different as far as, if you have your individual account and your joint account, IRAs, for example, or qualified accounts, as we were talking about with the banks, it would be 500,000 for a Roth and another 500,000 for an IRA. So
Mhm.
similar to the qualifications at a bank for FDIC, but a little bit different. But the coverage is $500,000, of which $250,000 can be cash.
Mhm.
And so, to your point, cash is a very unique animal, in that we're not just saying, stuff that you can spend at the bank. Money market funds are different than money markets because money market funds are investments. They
Mhm.
can lose value. They
Mhm.
haven't. And I don't know if we're going to talk about breaking the buck. But
Yeah.
this company or this insurance does provide liquidity and,
Yes.
insurance in case that we do have some. And that has happened. And so since 1970, over about almost 175,000 investors have been made whole.
Mhm.
And some scandals or some events that we probably have in mind are Lehman Brothers and Bernie Madoff. And
Bernie
so,
Madoff. Yep.
yep. So
Yeah.
that insurance did again step in to help make investors whole.
Unfortunately, post Madoff, there have been some changes in regulation to
Yes.
separate things a little bit more. But yeah, I think that's important to highlight again. So if you have a brokerage account and there's cash in that account, that's where SIPC would come in, if you will, from
Mhm.
a protection standpoint. You maybe see member SIPC. It's not going to cover if your stock drops. It will cover if, let's say, a brokerage firm becomes insolvent up to a certain amount, kind of similar to FIDC. But again, this has to do with a little bit different investment accounts, right?
Yep.
So I think again, those points are maybe helpful for folks to understand the differences. Last thing I just want to touch on, because there's been a lot of questions around like SVB. How did this occur? Could this potentially occur with another bank? So just to give you a brief glimpse as to how it actually did occur. So SVB purchased treasury bonds, and treasury bonds have a long maturity, let's say, right? We had interest rates spike, and that, because of an inverse relationship with price with bonds, causes the prices of bonds to fall. Then when customers had cash demands, well, they had to meet those demands. So they had to sell those treasury bonds, which had dropped significantly in value because of the interest rate spike, the sharpest spike we have seen. That then caused SVB to say, okay, well, we actually don't know if we're going to have enough cash to meet the demands and remain solvent, right? So it wasn't necessarily that they were making terrible loans. I'm not saying there wasn't some mismanagement there as far as how they set up their asset allocation, but I do want to point that out here as far as how this actually occurred. It was different, I would say, quite significantly than 2008. It wasn't like they were doing crazy things with, these different mortgages that, maybe were a little bit higher risk. It's actually just treasury bonds that was the key issue here. When interest rates spiked, the price came down. They had to sell those bonds, even though they could have held them to maturity and still
Right.
recouped the entire value of that bond. They had to obviously meet customer demands to get the cash out to their customers. And that's when, of course, they couldn't. So this
Right.
is a
And
reminder
to
that,
that, oh, sorry, Mike. I was just going to throw in too,
yeah,
that, holding a bond to maturity, that was their intent. And
right.
so many investors do that's, they're going to be made whole if they can just hold it to maturity. But as emotion tends to weigh into markets and to different things that happen, there was a good old fashioned run on the bank that one investor heard, oh my gosh, this SVB is really having trouble. Everybody go to the bank and get your money right now.
Yeah.
If all investors hadn't, or depositors, I should say, shown up and wanted their money right away, they probably could have been fine.
Yeah.
Because, they weren't investing in crazy risky things, but
Right.
yeah.
Yeah. And the good news is, account holders are obviously insured in this
Mhm.
case, not shareholders, which I would
Yes.
say
Yeah.
is a win walking away from this. So not maybe the executives that probably had quite a few shares in SVB, they're not protected. So they are likely losing a significant amount of money, whereas the account holders that were, they're being protected by FDIC in this case. So
Mhm.
again, if you're listening to this, my name is Michael MacKelvie. Make sure to subscribe if you haven't, if you're listening on Apple, Spotify, wherever you might be listening, YouTube. Make sure that subscribe button to get more industry insights from industry professionals here at Mariner Wealth Advisors. Valerie, thanks again. You guys take care.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.